Hello, everyone, and welcome to KJH Insights, our monthly podcast. I am Sarah Bull, partner and portfolio manager at KJ Harrison Investors. Thank you for joining us for our December podcast, where we provide you with an in-depth look at the biggest issues affecting the market and their impact on how we are building and protecting our clients' wealth. This is likely our last podcast before the end of the year, and joining me today is Joel Clark, CEO of KJ Harrison. Welcome back, Joel.
Hey, Sarah.
Nice to have you here as always. Joel, 2024 has been a really constructive year for risk assets. We had 3 pullbacks, but basically a nice upward trend for the market this year. And this past month, the market really seemed to be celebrating Trump's victory in the November election. So help us understand what's driving markets in your opinion and in the opinion of our investment team.
Yeah, it's a good point. Risk assets have done very well this year, right across the board and globally. And if you go back maybe a year and a half, we were always concerned that with higher inflation, higher interest rates, that there'd be an eventual recession. And that never happened. And so the number one reason markets have done well this year is the economy is strong. GDP is coming in around 2.8%. Inflation is down. Now, interest rates are coming down. We're in a very nice sweet spot for the economy, and the markets are really celebrating that. And like you mentioned, with the change in government in the US, with Trump winning, he's very pro-business. The animal spirits have accelerated. You're seeing the small business index tick up at a very fast rate. You haven't seen that in 4 years. We have a very pro-M&A government. There hasn't been any major deals in the last 4 years. Trump's, interested in lowering taxes, deregulation. So as I mentioned, the animal spirits are really revving up. You'll see a very hot IPO market. So capital movement is accelerating. Earnings estimates are climbing for next year as well. And, fund flows coming into the US. China's not doing well. Europe's not doing well. So again, the US is the best house in the worst neighborhood, and all the capital is flowing into the US. And for all those reasons, the market has been bid up in anticipation of another very strong year coming into 2025.
Thanks, Joel. That's a great market recap. So let's just dive into a couple of the things you talked about there. What do you mean by animal spirits, and what's unleashing these animal spirits?
Yeah, it's almost like that wealth effect. People feel confident that they can take risks. They believe the market has their back. They believe a lot of the big risks have been put to bed. So they feel confident that they can speculate. And when there's speculation, CEOs feel confident that they can make bids for a company. Think of the private equity world. Without an IPO market for the last 4 years, there are tons of companies that need liquidity. And they now feel confident that the market will be there to raise money. So this is more capital markets sort of commentary, but obviously it's a very important part of what we do. And confidence is everything. Confidence leads to people wanting to take intelligent risk.
And I guess that leads to your comment about small business ticking up, or small business optimism taking up. Is that right?
Yeah, and here's why that matters. Think back to my conversations over the last 2 years. Market dominated by the big seven. The big seven sucking the oxygen out of the entire market. The breadth has been weak. Well, that isn't the case at the moment. We've had breadth improvement. We've had small mid-cap outperform large cap. You think about the businesses that make up the Russell or the Russell 3000, all within the US, not these big multinationals. So with that confidence coming back, pro-business, the smaller companies are, stocks are really responding because the, CEOs of these smaller companies are feeling better for finally. They believe they have an administration that's very supportive. And so that's what I mean by the small business index.
Yeah, and I think that's a really good point, because we have spent a lot of time talking about the S&P 493 versus the S&P 7. So help us understand then the market right now. Do you think it's fairly priced, or what do you think of where it's at?
I think from a historical perspective, the market is fairly overvalued. Now, you can't completely hang your hat on just that one metric. So why can't you? Number one, it's also about the earnings. That's why it's called price earnings. The valuation is a multiple to earnings. Well, if earnings are accelerated or accelerating into next year, maybe the market is now cheaper on a forward basis. So you have to have a perspective on earnings. And then the second thing that I would qualify versus 20, 30, 40 years ago is just the dominance of asset-light business models, more diversified earnings, more predictable. I mean, with these mega caps that are all ingrained in our lives, the market is dominant by companies that have very sort of stable to growing earning power. And so it's an apples to oranges sort of comparison versus historical basis. Now, one who's taken a contrarian perspective might say a lot of this good news is starting to get baked into the market. So you do have sort of one eye over your shoulder. You are looking for things that might surprise the market. You know, you have seen prior markets where people take too much risk at tops, and then obviously a surprise happens and we see some form of significant correction. So you have to always remain balanced. There are risks out there. But all in all, the market is quite favorable going into next year.
And as we head into next year, how would you and how are the investment team thinking about risk?
Yeah, I'd say that the two, and it's the same risk we've almost always had, but a strong economy potentially reignites inflation. And if you reignite or inflation reaccelerates, you get a response from the bond market and interest rates go up. When interest rates go up, your cost of capital goes up and valuations come down. So you have that vicious cycle. So on the positive side, with a strong economy comes an overheated economy and the risk that, you know, the market had these big expectations. We're going to lower rates by 8 times by year end, and we only, you know, likely are going to get 2 cuts. And so I think there's the risk of an overheated economy. And then Trump's made some pretty bold statements on tariffs. It's unclear whether or not he's negotiating or he's in fact being serious. But if he is, it's unclear what impact that's going to have on certain industries or aspects of the economy or relationships with other countries. So there's definitely some risk there, but it's hard to know at this moment.
And let's talk about the Trump trade. People are talking about how Trump 2.0 is different than the Trump presidency in 2016. How and what about some of the policies he's talking about? Do they have teeth?
Yeah, it's hard to know, but he certainly says all the right things. He's put together a very competent team. He's coming across as a bit, I dare use the word wiser, but he's being a bit more sensible on certain policies that are pro-business, pro-market. So it's hard to tell. Time will tell, but just his very nature is such that he's interested in money and being scorecarded by the market. So, you know, we're sort of aligned in that manner.
Yeah, he really responds to the market, doesn't he?
Yeah.
Yeah,
Yeah.
uses it as his scorecard. I think the biggest question that a lot of our clients are asking is around the tariffs and the effect of the tariffs on Canada, and then the effect of the tariffs globally. Could they escalate into trade wars? Talk to us about the tariffs and the Canadian economy.
Yeah. So that's a bit more dour. Certainly, even before Trump got in, Canada's certainly been diverging, a much bigger slowdown, unemployment rate much higher, ticking up. We're cutting rates a lot quicker, which is leading to a much weaker Canadian dollar. And so then you take the added sugar on top of Trump putting or threatening tariffs, and that's not a good situation for Canada. So it's unclear to me whether or not that's a negotiating tactic or not, but I do imagine it'll put them in for a period of time looking for a response. But we certainly have a lot of work to do in our country. Now, what goes on in the Canadian economy affects, you know, your and my day-to-day lives. But, you know, as investors, we move capital around the world and the globe, and we can certainly avoid areas that we don't think are fruitful over the course of the next few years. So we're certainly more focused on the US at the moment. And so the risk of a weakening Canadian economy doesn't affect us as much. And so, we have to be mindful of all the implications, certain industries, certain companies, but we're pretty dominant in the US right now, and obviously much more enthusiastic about the US market that's going into next year.
And given that the US dollar just hit, $1.42 and the FX moves, how is that affecting our allocation to the US right now?
Yeah, it's a good question. Whether the US dollar goes up or down or the Canadian dollar up or down, we isolate that risk from the portfolios. Currency market is too tough to manage, too tough to call. So we hedge out that risk. And so we're really unaffected by those moves.
Okay, great. So switching gears just back to some of the risks, you didn't talk about debt levels of government. That's a big risk too. Can you touch on that?
Sure. We have accelerating debt levels in the US globally, always been a concern because they keep compounding at an exponential rate. And of course, with rising interest rates, it costs more to service. Now, part of Trump 2.0 is Doge, Elon Musk's team coming in to really take a cut at deficits. So out of nowhere, we now have a government more focused on fiscal prudence and following the Argentina model of becoming a bit more balanced from a fiscal perspective. So it's unclear how much they can improve, though it's certainly going to try. But that's another interesting perspective that the market is certainly rewarding right now, more disciplined government.
And what's the bond market saying right now? What's the story being told with credit?
Yeah, the two parts of the bond market, you have the credit market and obviously the rate market. Credit spreads have never been tighter. So the credit market does not foresee any issues going forward. And then the rates market is sort of stable. I mean, the 10 years at 4.3%, just sort of hanging in there, bouncing around, hasn't really done much, has been sort of trading in a range. For all intents and purposes, the bond, credit, and equity market all sort of support a pretty good environment heading into 2025.
Yeah, it'll be interesting to see if we have the same volatility like we had in 2018. Whenever Trump went to social media and sent out a tweet, the market reacted.
Yeah, it'll be interesting for sure. Won't be dull.
No, it will, definitely won't be. So, on that note, it sounds like your investment team really is watching inflation, watching earnings, obviously, and whether we get accelerating earnings in here. You're watching the debt levels as you've just talked about, and I guess whether Trump's policies, what will happen once Trump gets into office in January. What are anything else you want to leave for our listeners to think about over the holidays?
No, just to remind everyone, we don't really invest on a macro basis. We really focus on buying best of breed companies and holding them for long periods of time, run by very competent and aligned management teams. And so, who's in power, who's not, if growth ticks up or slightly ticks down, or if rates are up or down, really doesn't affect our decisions on a day-to-day basis. And so what really affects markets is generally growing earnings and growing economy and focusing on businesses that are growing at or above the average. And so we continue to be very, we're excited about next year. And especially if you get the breadth improving, because we don't invest capital concentrating our clients' wealth and having 40% in seven ideas. So if we get an improving economy, this is great for our equity strategies or credit strategies because we invest in a much more diversified basis.
Yeah, I think that's right. I think the key is maintaining our investment discipline.
Yeah, exactly.
I'm glad you brought that up. Okay, Joel. So I think that's it for our time today. Thank you, as always, for your insights and sharing your views from the investment team with us today. And thank you to our listeners. So we'll be back in January with another issue of KJH Insights and focusing on our perspective of the market. Again, thank you for a great year. As a reminder to our listeners, if you have any questions about your portfolio, please reach out to anyone on the investment team or private client team. And we'll continue to provide you with commentaries and updates on the market as the market narrative unfolds. Those are all available on our website at kjharrison.com. So hope everybody has a wonderful holiday season, and we'll speak to you again soon.
This podcast is produced solely for informational purposes and is not to be construed as an offer to sell or the solicitation of an offer to buy a security. The information herein is based on sources we believe to be reliable but is not guaranteed by us and does not purport to be a complete statement or summary of the available data. Any opinions expressed herein are statements of our judgment on the recording date and are subject to change without notice. Any unauthorized use or disclosure is prohibited. Receipt and/or review of this presentation constitutes your agreement not to reproduce, display, modify, distribute, transmit, or disclose to others the content, opinions, conclusions, or information contained in this podcast.